Welcome to another episode of Real Estate Investing Explained. Here's today's question.
I think when you have folks that have owned these properties for a long time, that have self-managed, they have a lot of their heart into the property, right? They didn't just buy it because it was just an investment. And so we've even tried to get creative with them at this point where they become a small equity owner. So they can, they kind of become part of a partner. That's kind of, more creative financing. So that there's a lot of ways to slice and dice it to know what's important to them. But yeah, we're in negotiations with a larger multifamily right now that the owner might be just a small equity partner. And that's another way to get into the deal versus having to raise the money or, over leverage, those sort of things.
I actually want to dive into that a bit more because that's an idea I've had too myself, and I've bounced it off my business partner. I said, what if we were to buy a property or we offer to buy a property from someone, and rather than just completely buy them out, maybe we leave them with a 5 or 10% stake in the property? You don't hear people talk about that much on podcasts. You don't even really see it online. So talk to us a bit more about that. What does that look like? What does the structure look like? How does it work?
Yeah, and I'll just tell you the evolution of what we've done in terms of financing, because we've really built our business by raising private capital. So what ends up happening on these larger multifamilies is that a lot of the structure is that, you give 70% or somewhere in that ballpark away to in essence, your limited partners, right? You're keeping as the general partner 30%. That's been a very common way we've kind of, managed and kind of structured the larger multis. In this particular, and then what ends up happening is your equity goes down, right? You're doing all the work. It's a lot of work. I mean, managing a large multi, you have an asset manager that you have more people involved, those sort of things. So anyway, then it's not a bad thing. It's just the way that it's structured or it can be structured. So then the question becomes, okay, so if you don't do that, how do you structure it in a way like we're saying with this owner? The conversation with this particular person was that they wanted to have the residual income coming in still. So, and this is something that they've owned for a long time. And we're trying to figure out, is there a way to have them in it for say 20%, right? They're a 20% equity holder of the holdings, the building. Even there's a creative way to say there's a phased out process, right? You could even phase them out in 5 years and then they get kind of completely out, or do they stay in for the length of the property? There's, we have smaller multis right now where we've struck up a deal where the investor is almost like a private lender / equity, where they're getting equity in the life of their kind of place in the LLC, but it's phased out over 3 to 5 years. And then we basically are buying back more of the building. So in 5 years, we own the building again, and they've gotten their money back and their kind of return. So there's so many ways. I think it all starts too, Robert, with what's important to the person and really what's important to the project. If we bought this other building and raised the money, our normal structure or the structure we've done with a 70-30 split, it financially wouldn't make sense for the investor. And that's really the biggest question, right? Is this going to make sense for people who are not giving us money. They're investing in the building. I always tell people, don't tell them you're not getting money. It's not a handout. They're getting an investment. I have to catch myself too. But so yeah, I think it all comes back to creative financing is how do you meet that person's need and also meet the needs of the project. And if you can't do all those two things, then it probably isn't the right fit. Because I don't think this project will work as well in the traditional sense financially.
Do you think that equity split, even if the seller's just keeping a small piece, do you think that works better with the medium to larger size multifamily? Or if somebody listening to the show today wants to do that with a duplex or even a triplex or a quadplex, you think that's possible?
I think anything's possible. And I think that's what people need to, I think what's really fascinating with how you slice and dice projects is that it's not like you're adhering to some policy, right? So when our first equity partner came on, there's not it has to be this way. And I think that's the good news, but also okay, we got to get creative here. And then what's the way to protect everyone? And kind of like the wild, wild west, right? It's anything goes. But I think it also, it's all possible. And our first equity partner, we went 50-50 with beyond friends and family and, my dad, that kind of thing. I mean, you have to, that's important, but the first non-family member, we just had a 50-50 partnership. We started an LLC and he had a role in the company. We were more day to day. He also had a strategic role in the company and in the project. And it was 2 single family homes and it was 50-50. And he put up 50,000. We didn't put a dime of our own money. And we were kind of like the local feet on the street. We had managed property. We knew how to turn around the property. We found it, those sort of things. That was a perfect connection. And then that worked really well, that structure. Equity is great when people don't I always tell people my husband's Mr. Raising Private Money. So I'm not going to go head to head with him on the details. But what I can tell you is that equity is great for people who want to be in something long-term. They want the cash flow, but they also want that. They want that tax benefit, right? They want that, all the other things that come in with being an equity partner. And then they win together, you lose together as an equity partner. Things may take longer than you would want. Lenders are great if they need that fixed amount because they're really lending the money and they want their interest rate, whether the project goes well or not. I mean, I've had flips, which really is horrible, right? We go to the closing table and you have to write a check to your lender. That's completely, not, excuse my French, but sucks, right? That's like you did all this work but that happens, right? That happens and no one can hit a home run every time. But my point in saying that is as someone who's trying to creatively finance your deals, you really need to know what's important to that other person. Do they need that fixed income? Do they want to win with you or lose with you, so to speak? Are they in this for the long term? Or are they just in it for 6 months, 9 months, and they want the return and they want to move on because their kid's going to be in college in 2 years or whatever? People's lives change. And I think we're so into our own world that I think really being really good at connecting with people that want to invest with you, you have to be in their world and you got to know, okay, this is what the deal needs. This is what this person needs. And this is what I need. And those three things they all matter because if one doesn't work, you're going to go into a deal, everyone's happy, and then you get nothing. And that's happened to us before. Not nothing, but you're just like, I'm doing a lot and I'm getting what? What are we getting? That doesn't make sense. And then, or the lender gets more of the lion's share. So the point in saying all this is I just think you have to be almost like that, truly customer oriented. You got to know what's important to that seller. And you got to talk to them and you got to really seek to understand them in their place.
That's all for this episode of Real Estate Investing Explained. Be sure to follow me on Instagram, Twitter, and Facebook, or subscribe to our YouTube channel to get even more free content.